Good evening, everyone. Good evening, Mr. Kindness, Mrs. Kindness. Um, Sorry, we are starting late because of due to some technical and logistics issue that is beyond our concerns. So today we'll be looking at a new fresh topic. And if you can see my screen, I would just want you to write something on the chat box or just tell me to continue. If you can just see FC online video lecture, financial accounting session 10. So we can move fast as possible. Hello, can anybody hear me?
Yes, we can hear you, sir. And we can see your screen.
Oh, great. Thank you. So as we know, the rules of the class remains unchanged. And I can understand that everybody has done that anyway. So today we'll be looking at preparation of an incomplete record. So what do we mean by an incomplete record? Incomplete record is actually a situation whereby the bookkeeper or the accountant in charge of the business did not keep up-to-date accounting records or do not have a double entry principle, does not keep the principle of accounting proper, and hence missing a lot or a bulk of huge of transaction in his book. So it is a situation that arises with a small business where the owner of the business has not kept up-to-date accounting records or does not have a double entry bookkeeping system. So he might also simply keep invoices and receipts for expenses and copies of invoices to customer. However, the details of bank transaction can also be obtained from the bank and other banking records. What does that imply is that the fact that this person is not keeping proper records, but he keeps proper receipts or copy of invoices to customer, we can use that to determine some of the line items we are looking for, or we use our bank statement to determine a lot of line items that are not complete in the accounting system. Take, for example, we want to determine our sales because our accountant does not keep proper accounting of transaction of sales. Then how, where and what do we actually need to look into to get or to determine the sales for the year? So things that we just need to look into is from our bank, we look at our debtors from the previous year, and we look at our debtors in the current year. And by the time we do plus or minus, we determine our sales. The same thing also implies to our purchases, but with all these things will be discussed as we move on in the class. So the purpose of this incomplete records is to get accurate details of some transactions like sales, like bank, like purchases, like debtors, like creditors, and so on and so forth. So that's the purpose of an incomplete record, or for example, your inventory itself. So let's look at a scenario where records have not been maintained because a dishonest employee has stolen cash or inventory. Whatever the cause of this problem may be, the accountant task involved in piecing together information that is available in order to produce a set of financial statements or to calculate missing figures. So what are the approaches we need to look at when determining or dealing with incomplete record? Number one is that we establish the value of assets and liability to calculate the business capital, particularly opening capital at the start of the financial period. Okay, for example, I'm sure you are aware that the capital plus liability make up an asset. So, for example, we don't have our total liability, for example, in our accounting records, but we have a complete record of our capital and a complete record of our fixed assets, our assets. Then if C plus L, that is our capital plus our liability, is equals to assets, then we can indirectly say that A minus C is equals to L. That is, asset minus capital will give us liability. Invariably is that if it is also capital that we are looking for, then we can also say that our assets, our total assets minus our total liability should be giving us our capital. So these are the plus and minus things that we need to actually get our familiarity with to determine some transactions that are not complete. Also, using memorandum of control accounts for receivables and payables to calculate sales or purchases for the period. Yes, like I said earlier, that for example, you want to determine your sales for the period, then you have to be looking at your receivables because that is the only line item that actually correlates as relationship with your sales for the period. The same also implies with your purchases. Then you need to be looking at your payables, your creditors, people you are owing, in order to see what you can actually determine from your purchases. And how do you look into this is when you are actually opening or you are familiar with your control account. Also, using memorandum of account for bank and cash transaction to establish a missing figures for cash income or cash payments, such as a missing figures of cash came from the business by the owner as drawings. So for example, the owners might just be taking some cash and you are not keeping proper records of this transaction. Hence, there are some ways and method at which you can actually determine those figures, either by looking at your bank statement, by looking at your cash book, and by looking at some maybe your capital account to look at what actually the total amount that the owner of the business actually took for personal use. Also, using cost structure to determine cost of sales as a missing figure, such as value of inventories stolen or lost in fire. If you're familiar with your gross profit margin, the net profit margin, your markup also, then you should also know that these are items that actually correlate with your inventory, because there's no way you'll be talking about inventory that you'll be talking about cost of sales. Remember, what determines cost of sales is our opening inventory plus our purchases plus our carriage inward less our return outward less our closing inventory. That is what makes up our closing cost of sales. So these are the line items you look at, because by the time you realize, you see that a lot of these things are given in our question. Just that missing part of that item is just for us to solve. Techniques for incomplete record. Like I said earlier, we know that assets is equals to liability plus equity. Therefore, assets then can also be assets minus liability is equals to equity. By bringing liability to this other side, then the liability will change to a negative sign. Then we have asset minus liability equals to equity. Well, the accounting equation is actually the same, but we are just seeing it in a different pattern. Therefore, change in one side are matched by change in the other side. Profit or loss for a period can also be calculated with the difference between the opening and closing net assets after adjusting for any drawings during the period. What does that mean is just that increase your net assets is equals to your profit plus your capital introduced minus your drawing. Well, your profit plus your capital minus drawings is also going to give you what? It's also going to give you your capital itself. That is the total capital itself. And remember, if you're having your total equity to be capital introduced plus your profit minus drawings, then we are literally saying that our assets minus liability is equals to your capital. However, if you look at it, then you will see that if this particular one is actually equals to your capital, in other words, is also your equity, then we can literally say that your net asset is equals to your asset minus your liability. So once you are talking about net assets, then we are discussing about asset minus liability. So asset minus liability is equals to equity. Then we can simply say that profit plus your capital introduced minus your drawings is also equals to your increase in net assets. The profit figure can also be calculated as follows. As you can see, closing assets minus liability, opening assets minus liability. Then the difference between the two will give you if it is increase or decrease in net assets for the period. Then you add your drawings, you subtract the new capital introduced, and the result that is going to give you is going to be profit for the year. So instead of you going to sales minus purchases or sales minus cost of sales, we give you gross profit minus expenses, we give you net profit for the year. But since we cannot determine our sales, nor we can determine the total expense, then, but we can also, no, we can determine the total expense, but we can determine our closing assets and we can determine our closing liability, same as our opening asset and liability. And we can also determine the capital introduced and also drawings. Then with this figure, we can start working back to determine our profit for the year. Let's look at an illustration, maybe to make it any sense. Remember that our assets is equals to liability plus capital. And also remember that assets minus liability is equals to your equity or capital. Great. Okay, example using accounting equation to calculate profit, for example. At 1st January 2013, Tom Business had assets of 214,000 and a liability of 132,000. At 31st December 2013, the business had assets of 281,000 and liability of 166,000. Tom took 25,000 naira in cash and 3,000 naira in goods out of the business during the year for his personal use. Now, any withdrawal from the business that is used for personal use is called drawings. Okay. And that is all we need to calculate our profit. It's not necessarily we have new capital. If we have, then fine. If you don't, then we can move on. Oh, he did not introduce any new capital. Okay, remember the formula is closing net assets minus opening net assets. The answer we get, if it is increase or decrease, plus our drawings, less our capital introduced, will give us profit for the year. I really don't know if this is actually making sense to you. Remember, let me come back to this place. Asset minus liability is equals to equity, remember. It is from this element of equity or capital. Another word for equity can also be capital. It is from this element of equity that we have our profit for the year. Then what makes up equity itself? If we are not using asset minus liability, the other thing that makes up equity is your capital plus your profit for the year minus your drawings. That is what makes up equity. And it's not necessarily you have capital for the period. So you can have your drawings and you less it from your total, or you add it rather from your net assets, and you determine your profit for the year. So if you're familiar with your accounting, this is just those manipulations you get around it to determine some figures that are missing. And the reason there's no figure is actually missing. It's just taking a longer way to calculate them. Let's go to the question. So we have closing net assets. What's our closing net asset? At December 2013, the business had assets of 281,000 and liability of 166,000. So if you less your asset minus your liability, remember I said that asset minus liability is called net asset. So 281,000 minus 166,000 is equals to 155,000. This is your opening, your closing net assets. Oh, you can even see it, net assets as at December 2013, closing. So what do we do? The same thing also applies to our opening net assets, assets minus liability again. And what is our figure? It gives us 82. But remember that we are actually lessing opening net assets from your closing net assets. That is why this is given, we are still having a negative figure for it. 115,000 minus 82,000, excuse me, is going to give you 33,000 naira. So if it is positive, then we are having increase in net assets. If it is negative, then we are having decrease in net assets. Situation whereby your closing net asset is greater than your opening net asset is called increase in net assets during the year. And if it is vice versa, then it is called decrease in net assets during the year. Then we add back our drawings. Our drawings is 25,000 naira cash plus 3,000 naira goods, making 28,000 naira. Guess what? The addition of the increase in net assets plus our drawings will give us profit for the year, 61,000 naira. Easy peasy, not that hard. The alternative method is also this method, increase in net asset 33,000, but then you want to ask that how did we get this 33,000? So that is why it is better to solve it in this method before we even go to this shortcut. We don't know our profit, our capital introduced is 0, and we have our drawings to be 28. Then by the time we collect like terms here, then we determine our profits. So it's as easy peasy as it is. So incomplete record is actually for looking for missing transaction, missing figures. So there are so many items that can be missing. However, if you know the items that are actually correlating with one another, then you will know where to look at in determining the items you are looking for. Like I said, if you are looking for your profit, then you need to be looking at your capital, correlation with it. Or you also need to be looking at your profit or loss account, also correlation with it. If you are giving expenses, are you giving gross profits, or are you giving gross margin on sales, or you need to mark up or on your purchases and to determine your net profit. Those are the things you need to be looking at. And if it is your sales you are looking for to determine, then are you supposed to be looking at your receivables, your debtors? Are you supposed to be working back from your net profit down or upwards to you get to your sales? Those are the things you also need to be looking at. The same also applies to your purchases. Likewise, the same also applies to your receivables and your payables. You just need to know the familiar items that you need to be looking at to determine all these missing figures. They're actually there. Is it to check your bank statements, to know the outstanding cash at hand that you have, or the amount that has been withdrawn that is not for personal, that is not for business use, for drawings, those things. Let's look at another example, maybe to actually make more sense. At the start of the year, a business had opening capital of 350,000 naira. The profit for the year is 200,000 naira. The owner had taken 120,000 as drawings. No capital was introduced in the period. At the end of the year, what are we supposed to determine? At the end of the year, the company cashier disappeared with an amount of cash. The owner was unable to identify the following balances at the end of the year. Property, plant and equipment, PPE, 95,000 naira. Inventory, 85,000 naira. Receivables, 65,000 naira. And liability, 55,000 naira. The missing cash balance can be calculated as follows. So we don't know how much it took, but with this information given to us, I think it is so straightforward and clear on where to look for our missing cash balance. So for example, let's look at it. What is our net asset? Our net asset is actually 35,000 naira, which is our opening capital. What is our profit for the year? Our profit for the year is 200,000. Our profit for the year is 200,000 minus our drawings is going to give us the net asset or capital. Remember, I said your capital is also equal to your net asset. Your net asset is your asset minus liability. Can you see how this thing has been interwoven? So we got our capital. In other words, we got our net asset. Then what can we do again? Then what makes up your net asset? Like I said, what makes up your net asset is your liability and your less your assets. Assets minus liability. See, we have been given your assets. These are your assets. And minus your liability. Once you minus this figure minus this 55,000, basically it's supposed to be your net asset, which is supposed to give you 430,000 naira. But if it is not giving you 430,000 naira, then the missing item is your cash. Because your cash is also a part of your net asset, your assets, which is actually not here. It's actually not here. So your property, plant and machinery equipment, 95,000, your inventory, 85,000, your receivables, 65,000, minus your liability of 55,000, it will give you 190,000. We are supposed to be having 430,000 so that this thing will balance. But no, we are not having it. So then what is the issue? We have the difference of what? 240,000. So that accountant actually stole 240,000. What makes up your assets? Your asset is PPE. Another PPE is like fixed assets actually, plus your current assets. What makes up your current assets? Your receivables, your cash, your inventory, and your receivables, your cash, your inventory, and your bank. So that's what actually make up your, what do they call it? Your current assets. And we are already giving our receivables, we are giving our inventory. And we are looking for cash or bank. So that's the reason why we make cash the subject of formula and determine how much he or she stole. So calculation of opening capital. It might be necessary to establish the opening capital of a sole trader. This can be done simply by obtaining figures for the asset and liability of the business at the beginning of the financial period. The opening capital is the difference between total asset minus and total liability. Non-current assets for this purpose are measured in their carrying amount. So what they actually say is that the non-current assets, or PPE, or your fixed assets as maybe popularly known, because it has now been changed from fixed assets to non-current assets anyways. So they said it should actually be measured at carrying amount after depreciation has been deducted. So let's look at an illustration, and maybe it will actually bring in familiarity to what we have been saying. A sole trader does not keep any accounting records, and you have been asked to prepare a statement of profit and loss, and a statement of financial position for the financial year just ended. To do this, you need to establish an opening capital of the business at the beginning of the year. The following information about asset and liability at the beginning of the year is available. So we have, So we have motor van, we have bank overdraft liability, we have motor van assets, we have cash in hand assets, we have receivable assets, we have trade payable liability, we have payable to other expense liability, and we have inventory assets. So we have two line items in particular, assets and liability. And we need to determine our opening balance. By the time we merge all assets together, how much is it going to be giving us? Then we will be looking at all assets. Can you see? All assets from the question. We have 1,006, we have 410, we have 850, and we have 50 naira. Remember what we are looking for, our opening capital. And I said our opening capital is equal to assets minus liability. Or better still, opening assets minus opening liability. So after adding these four figures together, it gives us 22,910 naira. Now let's list our liability. Then we have 1,020 naira. The difference between these two is going to give us our capital, opening capital that we are looking for. Easy peasy. Okay. So moving on, moving away from the capital or net profit or balance sheet related in looking for how to get our net assets, cash, or capital and co. Then let's look at our P or L line item itself, especially our sales and our purchases. A memorandum account is an account that is not part of the proper ledger accounting system, When there are incomplete records, the memorandum account can be used to calculate a missing figure. Such a figure for sales or purchases an expense in the period. So how do you calculate missing figure for sales? Remember what I said about you looking at receivables line item. Because basically receivables are the one that you are selling to, your debtors, your customers. They are the one you are actually basically selling to. So there's no reason why we shouldn't know how much we sold to them. So calculating the missing figure, the record of a sole trader might be incomplete because the trader does not keep any record of sales in the period when they will not employ proper accountants. Anyways, it might be possible to obtain the following figure. The receivables at the beginning of the year, that is from last year balance sheet, yes. The receivables at the end of the year from copies of unpaid sales invoice. Money bank during the year. We assume that this money are from customer. Any inflow from the bank are from customer. And any bad debt written off. Where the business makes some cash sales, there might also be a figure for cash sales where the money has not been taken, has not been banked. This amount of this cash might be calculated from the sum of any increase in cash at hand and at the end of the year, plus any expense paid in cash for which receipt is available. Do you get to understand that part anyway? When we're about to solve the question, perfect. So an accountant is looking through the record of a sole trader who does not have a bookkeeping system. Has established the following information. Receivables at the beginning of the year is 650. Receivables at the end of the year is 720. Bad debts written up during the year is 800. Money paid into the business account, bank account is 558,600. Cash sales where the money was not banked is 300. Then the sales for the year can be calculated as the balancing figure of receivables memorandum of accounts. Receivables at the beginning of the year is how much? 650. At the end of the year is 72,000. What does that mean? It means that more debtors actually came in. Like how much actually now came in during the year? 65 minus 720 will give you 70. Money paid into the business accounts is how much? 58,600. Okay, that means that 58,600 are money paid from the customers into the accounts. Cash sales, where the money was not banked, like the cash after they make sales, the cash they receive is 300. So is it 300 or 800? Yeah, 300. Then we have bad debts. Bad debt was written up from this old customer that you sold to. Some are already bad debt of how much? Of 800 naira. So by the time you subtract the money paid into business accounts, sorry, by the time we add up all this figure, then we will have our 59,770 770 naira as sales for the year. What does this mean is that, look at the beginning of the year. For example, today you sold 1 naira. Tomorrow you sold 3 naira. And tomorrow you sold 3 naira. In the beginning of today, rather, you sold one. Before, by the time you wake up, one person is owing you 1 naira. But by the time you want to go and sleep, 3 people are already owing you 3 naira. Then how much do you sell for the day? It means that today alone you sold 2 naira because of the existing one person that is owing you 1 naira, and by the time you close, another person is owing you 3 naira. So together makes it like you sold 2 naira worth of made of sales. So that's what is happening here too. That 650, by the time you wake up, you make sales 650 naira was the amount people were owing you. But by the time you want to go and sleep, people were owing you 720,000 naira. The difference of this figure is 70 naira. So it is 70 naira that you made today to people that are owing you today alone. Is 70 naira. Then out of your business also, some people actually pay to your bank, which is 558,600. And some people actually pay by cash, which is 300. And you now decide to write bad debt off of 800 naira. So those ones, you add everything together, it gives you 59,770 naira. Those are your sales. Likewise, your purchases too is also the same thing. Purchases are the payables at the beginning of the year, payables at the end of the year, money that is paid out. Remember, money came in, but this time around, money goes out to suppliers. And by the time you add all this together, they need to give you your purchases for the year. So that is the gist behind sales and purchases itself. Okay, so let's look at, so today we've looked at how to look at your capital. We've actually looked at how to look at your purchases, your sales. We've looked at how line items on looking at your profit itself. So let's look at line item, although we've looked at line items on how to determine your cash. Well, let's look at it one more time. A memorandum account may also be used to record transactions in cash, notes, and coins. And although the bank accounts, in order to establish a missing figure for a cash payment and possibly a cash receipt, you might be given figures for cash in hand and in the bank account for the beginning of the year. You can also be given cash in hand and in bank account for the end of the year, and cash receipts, payments during the period for purchases, salary, and other expense. So it depends, it's not necessarily they give you everything. So it depends on what they give you that you will now look on what to work with. So let's look at an illustration. A problem is that the owner of the business admits to having taken cash from the business, but he has not kept a record of how much he has taken. The accountant has established the following information. We have cash in hand for the beginning of the year. We have bank balance at the beginning of the year, cash in hand and bank balance at the end of the year. We have receipts. We have payment to employees, payment to suppliers, and payment to our bank charges and interest. I think this is just so cool. Everything was given to us, and we can just easily determine how much was we due from the bank. So in determining this, your cash at hand at the beginning of the year is 2005. You received 42,800 worth of cash. So it is expected that the amount in your bank account should be 45,300. However, out of this 45,300, you made some payment to suppliers, employee, and bank charges of 30,300 altogether. By the time you less them, you have 15,000. This is your cash at hand or cash at bank at the end of the year. Your cash in hand and cash at bank is 4,000 naira, which is, sorry. I think we were given cash at the end of the year. Where is our cash in hand at the end of the year? Okay, so we have 3,500 and 500 making 4,000 altogether. Okay, so let's look at this very tough one question and maybe we call it a day. And let's see. Just note that something is actually mostly common in incomplete records, previous year and current year, or let me say opening balance and closing balance. For example, when we want to determine our capital, our profit for the period, we were saying opening net assets, closing net assets, and we are adding up drawings. You know, when we want to determine our sales, we are talking about opening receivables, closing receivables. The same thing with our purchases, we are talking about opening payables and closing payables. The reason is by the time you subtract opening and closing, then you get for the period. Then if you can get for the period, then you can know that you are at least halfway gone over what you are looking for. The same thing with your cash. We are also looking for opening and closing cash line item. You know. So let's look at this question 3. Richard Jones keep incomplete record for his entity. Mr. Jones keep incomplete record for his entity transaction. The entity book revealed a net worth of 75,000 naira in January. However, on January 1st, 2017, however, Richard Jones sold and 3,250,000 naira on December 31st, 2017. You see, we are already given 2 years for the net worth of Mr. Jones. During the year, Jones sold his shares in some blue chips company of 2 million naira and also obtained a loan of 150,000 naira from his bank. The proceeds of this both The proceeds of this both sales share and loan were invested into the business entity. It took 150,000 naira cash for private use of the business during the year. Determine the profits made by the business for the year ended. Remember, the net worth of the business was 75,000 naira in January 1, 2017. The closing net worth is this amount. During the year, he sold part of his shares of the company of 2 million naira and obtained another loan of 150 from his bank. The proceeds from the sale of share and the loan were invested back into the business entity. So these two are like capital new capital introduced. So this is your net assets for the closing period, net assets as at the opening period. By the time you less these two, the difference, you add it back to your remember your drawings, then you less your capital introduced. If you still remember this formula, closing assets, that's 3.1 million. Your opening assets of that 75,000, your drawings of 120,000, if I'm correct, and new capital introduced, that's loan and the sales of shares of 2 million naira. So the difference is now what you have as your capital profit for the year. So this particular question is similar to the above illustration that we give to you. Django Enterprise is a distribution company, and he also keeps incomplete books of accounts. And the following balances were extracted. You have prepayments, we have cash balance, we have bank balance, we have furniture and fitting, we have inventory, and we have trade receivables and payables, and we have motor van. During the year ended February 28, 2018, the proprietor withdrew 350,000 naira cash from the business for personal use. Dividend of 5,600 from the proprietor private investment was lodged into the business bank account as additional capital. Note that, as additional capital. Furniture and fitting were to be written down to 68,000 naira, and motor van was valued at 500,000 naira as at March 31st, 2018. You are required to prepare the profit or loss made by the business for the year ended 31st March 2018. So we want to determine profit or loss. And to determine that, we need to determine our opening capital. So what is our capital as at January 2017? Our capital for January 2017, we actually don't know. But do you think we actually don't know? Remember, what is the formula for our capital? Our assets minus our liability is equals to our capital. So if you are not giving capital in here, all you just need to do is to separate your assets from your liability and find the differences there, and it's going to give you your capital. Sorry, I'm looking if they show us how they got the 358,400. 358, 400. Can you see? 600 minus 100 is equals to 500. 600. This is 600 minus 500. Motor van was valued at 500 at 31st May 2000, March 2018. So that's how we have our depreciation, because it has been depreciated. It was valued down to 500. Our furniture too, the same thing, 68,000 naira inventory. So by the time we add our assets together, we add our liability together, we subtracted it, it's going to give us 3,250,000 naira. Then what is our drawings? What is our drawings? Our drawings is how much? He said he withdrew 350,000 naira cash for personal use. He withdrew 350,000 naira for personal use. Sorry, is it supposed to be 350,000 naira? Okay. So you have payments. Are we missing some item in this question? Dividend. Dividend was this from the proprietor private investment was lodged into the So you have bank balance. We have okay. What are our drawings? Our drawings of 150, and we have our 3,400,000 naira. So I'm looking for how we got our drawings into this picture of 150,000 naira. And now we have net assets of, as of December, to be 75,000. So what is our net assets here? By the time we subtract all this item, by the time we subtract our assets from our liability, it's going to give us 75,000. Proceeds from shares. Remember, we sold shares of 2 million. Then we have a balancing figure of 150,000, which is also our drawings from here, I'm sure. Then we now have our net profit. So the addition of this net assets from and your proceeds from shares plus your net profit will give you 2,225,000 naira. Less it for 3.4 million is going to give us 1.175 million. I'm coming. Let me add up a little. Let me look for my calculator to show you. Calculator. How 150 was gotten. So we have cash balance of 1,114,000, which should be actually somewhere here. The calculator is freezing. So we have our net assets here to be 3,548,400, which is 3,548,400. This is for Django, and this is for Richard. And we are looking for determine the profit for the year in the book of Richard. Okay. Sorry, so this particular one, this is the solution here. This is the solution for this very first one here that I've already explained. I was wondering where that figure was coming from. And this is the Django Enterprise itself. So the Django net assets for 2018, March 31st, was 3,548,400. And how was that gotten? By adding all for 2018, all the assets and leasing liability from it, we give you 3,548,000. Add back your drawings. From the question, we have drawings of 350,000 naira. By the time we add it together, we have 3.898 million. The same thing also applies to our previous year. We add all the assets and subtract it from our liability. So we have our net assets. Do you have a capital introduced? Yes, the dividend that was paid to them was reinvested into the business. That is dividend of 5,600 naira, which was added. And by the time you less the two together, it gives you your net, your profit for the year. And this is a negative figure, so which gives you a loss for the year. So basically, you are just adding your asset, you are lessing your assets from your liability in order to determine your profit from these questions, from these whole questions here. There's no big deal about it. Just know that by 2018, your what do they call it? Your motor van that was 600 has already reduced to 500 due to depreciation. So we are not using this figure in 2018 any longer, but we'll be using 500,000 because of depreciation. The same thing also applies to your furniture and fitting. Instead of 80,000 naira, we'll be using 68,000 naira. As it is from here, can you see 68, because we've deduct the depreciation value from it. So that is that for incomplete records. You can look at question 3 of May 2017, and if you feel that you have any question or you still don't understand it, you can just ask in the group, and we'll always be available to answer you. It's actually easy, and in fact, the solution is also there. And if you just feel that you have any question, you still don't understand how some figures are basically Latin, you can easily drop it on the WhatsApp group. We will be there to respond to you immediately. And with the little minute that is remaining, I don't know if you have any question, if you can just type it, or we'll be expecting it on WhatsApp group. We're having it on WhatsApp group. And in the absence of none, I would love to say good night. Thank you very much for joining.